This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and finish the world of tax by going global. Hope you've all got your passports with you as we start to look at international taxation issues. Okay, the issue that you've got there essentially is looking that if we set up another part of our business overseas. So let's just say we're based in your domestic country. For me, that is the UK, and I decide to expand my empire and go through there and set up operations in parts of Europe, in parts of Africa, in Asia, or maybe in America. Okay. Key bit there is, how are my profits going to be taxed? I'm based in the UK, but I'll be generating profits elsewhere around the world. Well, what we need to do there is we need to determine residence, okay? And that's how the tax authorities go through there and begin to look at it. Everything about your tax, it is about your residency. And rules do vary from one country to another, but sometimes there will be tax agreements between countries that determine whereby your residence is. But what we've got there is that the main tests for establishing residence tend to be there looking at where your effective management and control may be. Okay, that tends to be there deemed where your company is actually a resident. So even if maybe my business is set up in the UK, if I'm over, say, in Switzerland, and that's where I carry out all the decisions, and that's where my management and control is based, then we will be Swiss residency based. Okay. Other ways of thinking about residence are looking at your incorporation. So if I am a UK incorporated company and my management and control is in Switzerland, then I could essentially be dual resident, couldn't I? In which case I will pay tax in the UK, I may pay tax in Switzerland. But again, what we may see afterwards is there may be a little bit of relief for the fact that I have paid double the amounts of tax. Okay. And then what you've got there is looking at what's referred to as a permanent establishment. Okay, if you conduct your business through a permanent establishment, then that can be deemed to be your resident country. When we're talking about permanent establishments, tying back into your effective management and control, your place of management. A branch is a permanent establishment, an office, a factory, a workshop, a mine, oil or gas well. Just be careful, a building or construction site is permanent residence if you are there for greater than 12 months. Anything less than 12 months, it's not deemed a permanent residence, so you will not be taxed on the profits that you make from that building or that construction site where that is taking place. It will be taxed based upon where you are normally resident. Okay. So I think the key bit that you've got there is you can see that you can be resident for tax purposes in more than one country. Okay, which gives you the issue there is it of double tax. But what can happen there is, with regards to double tax, you can get relief in one country from where you have already paid the tax. Okay, so double tax relief essentially is whereby you reduce the incidence of tax being paid twice. So you may pay tax in the UK at 20%, you may pay tax in Switzerland, say, at 30%. You will get relief for the fact you've paid 20% already in the UK and just pay an additional 10% there within Switzerland. Okay, so that you're not taxed 20 and 30 on your overall profits, and that's quite a big tax burden, isn't it? Okay. However, what you could have as well is we look at the tax models that we have. OECD, the Organization for Economic and Cooperative Development, sort of like a global body that suggests how we go through and deal with that problem there of double tax. And they go through there and focus on your permanent establishment. So if you happen to be resident in more than one country, the OECD suggests there that it should be based upon your permanent establishment, and the main one that we have there is usually thinking about your place of management and control. Okay, that's the key determinant of your permanent establishment. Okay, particularly as well if there is a double tax treaty between the parties. Okay, Excellent. So where's your management and control fundamentally? Then what we've got is we just bring in a little bit of numbers. There aren't many numbers but within this part of the syllabus, looking at your international tax, but there's some small tricky little numbers to go through and look at here, because we need to look at the different types of foreign tax that are payable. Okay, because what you've got is, if we draw it up, you can see that it talks about, is it your underlying tax and is it your withholding tax. So let's just say that we are a UK company, and that UK company has, if you like, another company overseas. So an overseas company over which it has an ownership interest. Okay, so let's just say that the UK co, shall we say, owns 30% of OSCO, the overseas company. Okay, so what's going to happen there? It is based upon that you will receive some dividends, won't you? You will receive dividends from that overseas company. The problem is that those dividends that you receive will be received after all of the taxes that the overseas company has gone through and paid. Okay, so we need to look at the different types of taxes that the overseas company has gone through and paid. So let's just say that the overseas company has your profits before tax of, shall we say, £100,000. The tax that it pays is there as 20, so giving it profit after tax of 80,000. Okay, and what then happens there? Let's just say that they pay a dividend. The dividend we'll just say is 40,000. That, if you like, is the gross dividend, isn't it? And that 40,000 has already been subject to tax, hasn't it? It's already, we would be able to pay a lot more of a dividend if we hadn't suffered that tax in the overseas company. Okay, so what you've got there, going through and looking at these definitions, the underlying tax that you have there is the dividends that is paid out of post-tax profits. Okay, so if a company in country A receives a dividend from the company in country B, so country A was our UK company, country B was our overseas company, the dividend will already have been taxed in the overseas company before we get any receipts. Okay, that tax is the underlying tax, isn't it? Okay, so what you've got there effectively is we've paid tax of 20,000. The underlying tax, I suppose, on that dividend is 10,000, isn't it? Okay, it's because you've had tax of 20. The dividend you paid out was half of the profits, so you want half of the tax. Okay, so effectively what you've got there is to work out the underlying tax. Underlying tax that you have on the dividend that's being paid. Well, the dividend that you have gone through and paid is it 40,000? The tax that was paid was 20 in total out of, is it 80, which gives you 10,000, isn't it? Okay, that's the underlying tax in relation to that dividend, isn't it? Okay, because what you've got there, it's all done proportionally based, isn't it? Okay, if you had profits of 40, what would be, if you like, the tax on those profits after tax of 40,000? Okay, yeah, proportionally it is 20/80, isn't it? If you wanted to learn things as a formula to work out the underlying tax, that would be, is it your gross dividend? You take the profit after tax, and is it the tax expense? Okay, there we have it. Okay, that gives you your underlying tax there is at 10,000, and sometimes, depending upon the double tax treaty, when the UK company receives that dividend ultimately, so 30% of it, it will be able to reclaim part of that underlying tax. Okay, so just to recap, the underlying tax is the tax that's being paid out of your profits on the dividend that you are about to receive. Okay. In terms of your withholding tax, that's like a border tax, and it's trying to prevent your dividends going overseas, because of that gross dividend, what goes through and happens there as it crosses the border, the amount of dividend that the UK company receives is 30% of that 40,000. So is that there at 12,000? So let's just say that the withholding tax, shall we just say it's there at, is it 10%? And that's 1,200, isn't it? So the dividends that you receive ultimately, I think, would be there, is it at 10,000? Is it 800? Okay. So you receive dividends, is it there, 10,800? And that dividend, it would effectively be more, wouldn't it? If there was no withholding tax, if there was no underlying tax on that dividend. So in some jurisdictions, you can reclaim the underlying tax to, if you like, then gross up that dividend and reclaim it. Some jurisdictions, you are not allowed to reclaim it. Okay. Again, bits and pieces. The withholding tax definition there. Many countries, payments made abroad are subject to withholding tax. The type of payments normally subject to withholding tax include interest, dividends, capital gains. I think you could incorporate royalties, rent within there as well. Okay. Excellent. Again, if there's a double tax treaty, then potentially that will eliminate your withholding tax. But a lot of the time, questions will ask you to go through and ask you to work out the withholding tax, and they will also ask you to work out the underlying tax on your dividend that you have received. So key bit there is that you need the gross dividend, and you need to look at it from your perspective as well. Okay, we've worked out the total underlying tax. Obviously, in our scenario there, the amount that we could go through and reclaim would be 30%. 30%, that gives me 3,000 in relation to the dividend that the UK company has received. Okay, let's just piece that together with a bit of an example. So it is a real past exam question, obviously from the very, very old syllabus. So prior to 2007 when it changed, and then prior to 2015 when it changed again. What have we got? These questions are still relevant because it's still in the syllabus and you're likely to see it again. So it wants us to work out the amount of withholding tax paid by CW. Okay, so that's looking at your domestic company. How much tax has it had to pay to receive potentially the dividend? Okay, so that withholding tax, that border tax. Calculate the amount of underlying tax as well that relates to CW's dividend. Okay, so not like we saw before in terms of the total amount of underlying tax that you had here. It's looking for this amount here. Okay, the amount that related to the dividend. So let's go through, look at the information, play around with it. It says CW owns 40% of the equity shares in Z, which is a resident in a foreign country, which is why you have underlying and over withholding tax as well. CW receives a dividend of 45,000 from Z after the deduction of withholding tax of, is it 10%? So if we're looking there, is it at part A, and looking at the withholding tax, then what you've got there is that you have gone through, and is it the receipt that you have is 45,000. The withholding tax is 10%, isn't it? Okay. Now you just need to be careful, because the withholding tax is after the gross dividend, isn't it? So the gross dividend is relating to 100%. The receipt will therefore be 90%. So to work out the withholding tax, it's not 10%, it's 10/90. Okay, so that's the as 5,000. Okay, it's like thinking about sales tax, isn't it? You know, this is the net amount, this is the tax amount, this is the gross amount. So if we're given the net, we need to apply 10/90, don't we? Okay, so that's the withholding tax. So the withholding tax that we've calculated is 5,000. And then it said Z had profit before tax, so just be careful. That's profit before tax of 500, and paid corporate income taxes of 100,000 as well. So what we've got in part B is it wants us to work out the underlying tax. Is it there on CW's dividend? So our gross dividend is there as 50,000. The tax that was paid was 100. Be very careful. The profit after tax weren't given, so you need to calculate them, don't we? Okay. So what you've got there, 10/4, or 100/4. 100 is a quarter, isn't it? A quarter of 50 is 12,500. Okay, so that is the underlying tax that, depending upon the tax jurisdiction, may be allowed to be reclaimed. Okay, there we go. Okay, so if there was no tax within any of the jurisdictions, we wouldn't have got 45. We'd have got 45 plus the 5, which is the 50, and the 1250, which would be 6250. But because of underlying tax, because of withholding tax, we only actually received 45,000. Okay, there we go. Work that question through again. Again, I think what you find is that the formula for your underlying tax, if you remember it, should help you all the time. You take your gross dividend, you take your tax, and then you take your profits after tax, don't we? Okay, there we go. Excellent. Last little bit just to go through, finish it all off before you get stuck into absolutely everything and work so hard like you've never worked before on all of these areas of the syllabus. It's just such a massive syllabus, isn't it? And it's all, I think it's a bit disjointed, isn't it? You've got this tax, this working capital, you've got accounting standards, you've got groups, you've got your ethics stuff and governance. It just doesn't flow very well, does it? Okay, so I tend to do it in silos. Focus on one bit and then focus on the next. Don't try and do both, because I think it does get you confused. Okay, so it's all about a branch versus a subsidiary. You are setting up overseas. Are you better off to set up a branch or to set up a subsidiary? Okay, well, it all depends upon what people view the branch and the subsidiary as. I say people, that the tax authorities, because it's going to be important about how your profits are then taxed. Because if you set up a branch, that is the same legal entity. So even though it is overseas, it will be taxed as part of your profits back in the UK, presuming therefore that the UK is where you have your domestic residency and are therefore taxed. However, if you set up a separate legal entity as a subsidiary, then it is viewed as a separate legal entity. It has a birth certificate, it is incorporated overseas. If that's the case, then that will be taxed overseas. Okay, as well as being taxed overseas, it may also be taxed back in your domestic residence. So there could be, if you like, some double tax issues that arise there. So what you've got there in terms of how things work, if you've got a branch, then your branch profits are liable in the main entity's tax computation. So whatever profits the branch makes, they are taxed back in your domestic residence. However, the subsidiary profits are not taxed in your domestic residence unless a foreign dividend is received. Okay, so maybe set up a subsidiary overseas so that you don't have to pay tax on the profits. Okay, you only pay tax back in the UK when the dividend is received. If you have a branch, your gains are there again liable in the main tax computation. So if you're selling assets, it might not be an idea to set it up as a branch, might it? Because if you make a gain, it's going to be taxed back in your domestic residence. Whereby, however, your subsidiary is not subject to capital gains made by the subsidiary. Okay. The next one I think is very important as the crux as to whether you set up a branch or a subsidiary. You know, here, if you have a branch, because it's the same legal entity, your losses can be set off in your main tax return. So if you have a loss-making branch, which essentially it might be when you first set it up, those loss-making branches can take the losses, those trading losses, and use them against your profits on your own overall tax computation. Whereby if you have a subsidiary, your losses cannot usually be set off against the parent's profits. Okay, there may be a process of group relief, but group relief is definitely being phased out there within the UK, so I'm not too worried about that. Okay. So what tends to happen there is that if you are setting up an entity overseas, what I would go through and do first of all is that if you expect it to be loss making, then I will go through and set it up as a branch first so that you can utilize those losses. And then what I would do is that when it then becomes profitable, I would then go through and incorporate and set it up as a subsidiary. Okay, there we go. Again, it just starts talking there about the transfer of assets. Again, whilst it's a branch, maybe you're setting up the business and you're moving assets between the branch and your main part of the business back home. So that is not subject to corporation or capital gains tax, whereby if you have a subsidiary, it may be subject to capital gains tax. And likewise, when you're a subsidiary, you will buy and sell goods between the parent and the subsidiary, so there will be potential transfer pricing issues, which brings in potentially then is it maybe tax avoidance. You can manipulate or adjust your transfer pricing to make the best advantage of planning issues. But again, that then brings around, doesn't it, a little bit of ethics. So the key bit essentially is that the branch is the same legal entity. Everything that is profitable within the branch will get taxed straight away back in your domestic residence. But if it's loss making, you can use the losses. So if you anticipate the branch or your overseas venture being loss making, then set it up as a branch, and then when it becomes profitable, convert it into a subsidiary, because then the profits won't get taxed and then until the dividend is remitted back. Okay, there we go. Excellent. Other than that, keep up the hard work and then see how it all goes. Please make sure that you go through there and use the forum to go through and ask any questions that you may have.